Good morning, good afternoon, and good evening, everyone. We'll give a couple of minutes for our attendees to join in, and then we'll start this webinar. Okay, so while people join in, I'll just extend a warm welcome to everyone who's joining in from different time zones across the world. Welcome, everyone, to the webinar hosted by Dun& Bradstreet Worldwide Network. Um, we have the topic of global bankruptcy trends post-pandemic swell of business failures. Over the next hour, we'll explore the trend in global bankruptcy along with the reasons behind it. We'll also be discussing on about how businesses nowadays face risks spanning beyond credit risk. We will be delving deeper into the strategies. And today we have the pleasure of hosting our esteemed guests, Dr. Arun Singh, our global chief economist, who will be sharing his expertise on the current global bankruptcy trends. Tim Vine, our vice president, product management, Dun& Bradstreet, who will be discussing what the strategies for mitigating various type of enterprise risks. Before we begin, I would take a moment to lay down the housekeeping reminder. Please note that all the lines are currently muted, and we encourage you to ask questions via Q&A chat box. Our speakers will be addressing those in the designated Q&A session. A reminder also that this webinar is being recorded and will be available shortly after the completion. If you have a feedback or a suggestion, please feel free to put that in the chat box or you can mail us. So without further ado, it is my pleasure to hand over the virtual stage to our first speaker, Dr. Arun, for sharing his valuable insights on global bankruptcy trends. Over to you, Arun.
Thank you, Madhu. Thank you for introduction. And good morning, good afternoon, good evening, depending on which market you are dialing it from. Thank you for joining and welcome to the Global Bankruptcy Trends webinar. And this is very timely. I think after pandemic, this is most discussed subject on the planet. I know during pandemic, there's lots of learning we had, not just on the health front, also on the business front, on the economy front. In order to protect the economy, in order to protect the businesses, government and the company have taken various initiatives during the pandemic. Government, for example, have gone all over the places to support the company across various sectors, various segment to ensure that they are healthy, they are competitive, and they are doing good job. So they came up with various initiatives during pandemic. Post pandemic, I think multiple things went in front of government. There's multiple challenges government used to face. As a result of that, many government have decided to roll back those support measures, and as a result of various geopolitical concerns, economy slowdown and economic challenges, and some of the government inability to support companies outrightly have created a problem in for what we call it balance sheet issues for the companies. And as a result of that, many countries, many companies have reported a bankruptcy. Today, I'm going to talk about that things. My name is Arun Singh, and I'm a chief economist at Dun& Bradstreet for more than 1.5 decades. And when I talk about global bankruptcy trends, largely we are going to cover something around 45 countries, and we'll see that how the bankruptcy have basically evolved in those countries, and also try to capture some of the macroeconomic parameters which ideally we should monitor which ideally we should track in order to see where the bankruptcy might go in 2024, rest of the month, and the 2025 and beyond. Because lots of things happening, lots of initiatives being taken by the government and the company, but there are challenges on the ground. There are various initiatives on the ground being taken, but there are issues, there are problems which we should be aware of. So I'm going to touch base in a detail for some of the areas, some of the macroeconomic parameters. With that, if I go on the first things, in 2023, what we have seen, and when talk about the number of bankruptcy, corporate insolvencies in terms of the number was highest in last 10 years. Even in I think 5 6 years before pandemic and after pandemic, whatever number of years when we put together in 2023 was highest, not just in terms of the actual volume of bankruptcy across those 45 countries which we monitor, is also in terms of the growth rate. 2022 is the year when the government started rolling back their support measures. You all might have the awareness that 2020, when the pandemic struck, government across countries basically came forward to support companies. They had various initiatives, support, and protection in terms of the regulation, in terms of the financial support, multiple things they have done. But government balance sheet itself was under trouble during 2022, and the fiscal consolidation was at a risk, and most of the countries monarchs have seen the public debt surging and their own debt gone up. As a result, they basically started rolling back, and outcome was the bankruptcy shot up. There are many companies were literally on the edge of the bankruptcy, and they were surviving on the government support. They slipped into the bankruptcy phase during 2023. Many things happening today on the ground, and probably in 2024, when we get the data, I think things will be slightly worrying, because first 6 month data, which I have in the subsequent slide, is slightly concerning, because that data is certainly not looking good. Moving on to another piece of information or the analysis what we have done on those 45 countries. More than half of the 45 economies which we monitor for this particular study have seen significant surge in terms of the business failure. And if you talk about those growth rate for the 45 economies, or half of the 45 economies, 58% the companies have reported the bankruptcy, countries have reported the bankruptcies, and that's more or less same what we have seen in 2022. So that's flattening off. 60% of those countries have reported bankruptcy, and the significant bankruptcy we have seen during 2022 and 2023. Even 2021, in spite of the support from the government, we have seen some sort of a bankruptcy. That's more than 50% of the countries reported bankruptcy even that year. Now, moving on, when I talk about what the growth rate they have displayed for some of the countries, if you see, uh, you know, 20 economies, what we found out of 45 countries, they've reported more than 10% bankruptcy in those countries, led by US with almost 80% surge in the bankruptcy as compared to 2022. So the US is leading the charge in terms of the bankruptcy reported in 2023, with 80% jump in the number of cases they have seen, followed by the Canada, Poland, Netherlands, Ukraine, and of course in India. The lowest in terms of, when I say the double digit or more than 10%, was reported by the UK, just 12%, but 12% is still very high number. That's double digit growth rate we have seen. So there is a variation in terms of the bankruptcy what being reported by some of these countries. Multiple things. Some of the government still have some of the support measures. Some of the government have withdrawn completely. Some of the government are basically planning to withdraw probably in 2024, and there are some issues happening. As I said in the previous slide, that our Government itself, their balance sheet is not that healthy. Government does not have appetite across these countries to support companies beyond certain limits and condition, and as a result of that, there is a variation in the growth rate of the bankruptcy. But in summary, there is a significant surge in the bankruptcy we have seen in 2023 and even the first half of 2024 so far. But there are some good news for some of the countries. There are 11 economies which we have seen out of 45 reported decline in the bankruptcy. For example, Denmark is an 11% decline in the bankruptcy. Croatia, Belarus, something around 35, 29% decline in the bankruptcy, which is good news for these countries. Somehow they have managed. Maybe doing some effective operation for the some of these companies. So these countries have done good job in order to manage the bankruptcy in their countries. But macroeconomic parameter, as I was saying, that certainly looking tense in 2024 and beyond. There are geopolitical tension. This is the scenario. These are the country I think we should be watchful that when they're going to turn into the positive territory. That's maybe the turning point. We need to be careful and we need to be watching that piece. This is the weekly bankruptcy filing in the US. We have seen, last 3 years. The what you call the dotted line, if you see, that was the bankruptcy file in 2022. That's the lowest you can see. There's volatility, but there's the lowest data point we have seen. Then the dark, the gray line was in 2023, but the blue line is basically 2024, first 6 months of 2024. But look at the data point. If the blue line is higher than 2023, is higher than 2022. That was the point I'm trying to say, that even the US is basically, look at this, every 6 months, most of the week they've reported higher number of the bankruptcy in 2024 so far. If everything goes in the same direction, what basically is happening, probably rest of the month will have the higher number as well. So we need to be basically careful and watching those statistics as the number comes in. The multiple reason I was talking about earlier, and from economic side, the government support, government role, demand, supply, geopolitical concerns, and the other supply chain related issues. But one thing which we all have seen, the inflation was very high, and as a result of that, the countries, the central bank of those countries, talk about some select Euro area, ECBs, Bank of England, Fed, they kept on increasing the interest rate in order to control the inflation. And this is not just three countries or not three regions, multiple, across many countries on the planet, they have done this one. Most of the countries, at least at a lower end of spectrum in terms of the developing market, underdeveloped market, some of the countries have started bringing interest rate down, a policy interest rate down. But the Fed, I think we got the sense that they want to hold on for some time. Euro area, good news that they basically slice the interest rate in some time. But in a nutshell, there are some problem in the economy. There are inflation still, and not that so much. The central bank is not convinced about the lower inflation rate at this point of time, and that's the point that they kept the interest rate at elevated level. Now, there's two things we need to be mindful of. This one is not just the policy interest rate. What level is that? It's a transmission of the lower policy interest rate to the lending rate. That will take its own time. So the thing is that the interest rate is still elevated level. By the time Fed or any other central bank start cutting interest rate, it will take its own sweet time to pass that cut in the interest rate to the larger, the companies, in order to have a lower borrowing cost. So that's one of the prime reason that the borrowing cost is elevated. There is a very, very thin demand for the new investment happening. Things are changing on the ground, but so far it's certainly impacting the balance sheet of the companies. That's one thing. Moving on, another problem what we have seen is the changes in the total non-farm payroll. I think that's data. The data you can see, there's still very robust data for last few months, and for a year actually in terms of the total non-farm payroll data, and that gives some what you call support to the Fed not bringing interest rate down, and that's going up, which is economically which is good, and that's how central bank of the U.S. and some of the countries are holding interest rate at the same level that they can survive without cutting interest rate, because inflation is still not giving any convincing sign of moderation at this point of time. Now, another part, I think I was saying that while the global inflation is coming down, but still, elevated as compared to the pre-pandemic level. The level what we have seen in terms of what talk about the headline inflation, the food inflation, or the energy price, it's more or less higher than what it used to be pre-pandemic. And second thing is that given the supply chain constraint, given the ongoing supply issues, what's happening. In the world from the east to west, central banks is basically not convinced in order to bring it down, and that's there's a restriction, that's a hindrance for the central bank to cut interest rate at this point of time. Some of the point, I think we should, as I was talking about supply chain, and we should be basically mindful of this one, that probably this might be a hindrance for the inflation rate to come down, and probably a constraint for the central bank to keep interest rate lower or bring it down, and in turn keep the borrowing cost at an elevated level, and in turn will have a further dent in the balance sheet of most of the companies who are leveraged or basically have investment plan or capex cycle or something, going to have a major concern. So which means the balance sheet of the most of the company not looking good. One parameter you might have noticed that there's 85% decline in the number of vessels passing through the Suez Canal since end of the 2023, because this is the shortest route from east to west in order to connect, and 85% drop is a huge number, and that's basically diverted to 125% to what we call the Cape of Good Hope in the same time. And that's not coming on a very very low cost or low time. That's taking a toll, because it's completely the entire ships have to basically change the route and taking more time. It's costly, and creating a pressure on the supply chain and creating a disruption on the supply chain, which means there is a natural pressure on the input prices, there's natural pressure on the commodities, while the company is trying to find a middle ground, but the scenario is likely to continue for some time. In terms of the time, if you talk about, it takes more at least 1 to 3 weeks additional transit time what it used to take during Suez Canal route. The Cape of Good Hope certainly taking 1 and 3 weeks extra in terms of the transit time. And the prices, I think you all might have noticed that the 4x increase in the global container shipping prices so far we have seen, and that they're passing into the higher supply chain prices, higher supply prices of those commodities, and in turn input prices is going up. And if companies are able to pass those increased prices, then they are able to pass to the consumer. But unfortunately, uh, the demand is not that robust. So companies are not able to pass those increased input prices to the customer, which means they have to bear the cost, which means the additional pressure on their balance sheet in order to have, from a higher input cost, lower selling price, which means the profit margin squeezing, having additional pressure on the balance sheet. Now, earlier I was talking about the government support. I think one of the biggest threat today is the fiscal consolidation plan of the most of the countries. That's on the risk. The general government gross debt, if you talk about, irrespective of which country it belongs to, the advanced economies, the developing economies, the average gross government debt as a percent of GDPs have gone up, which means the government has been really under stress in order to have extra money spent for the companies or some other stuff, because they're already, the debt is so high. Look at the average debt for the advanced economies, that uh, you know what you call the orange line. That's That's very low. That's close to 103, 104. But now it's gone to 115. That's average. It's same thing for the developing economies. So irrespective of advanced economies, the developing economies, countries are struggling, governments are struggling from the gross debt perspective, which is the reason that probably they might not be able to help companies beyond certain limit, and that's going to take a toll. In a summary, I think from a company side we have a problem, and from a government side we have a problem. From the macroeconomy side we have a problem, and one thing, the higher debt servicing cost. From a government side and from a company side, both, given the interest rate is elevated, interest rate is higher across countries, both having basically the higher servicing cost at this point of time, and the debt is basically already taking taking a toll on that. The financial condition, as I said, is not that great, and most of the countries' interest rate at the same level. Of course, euro area decided to cut it down, but transmission from the policy interest rate to the lending rate will take its own sweet time. Its condition for the financing is very tight at this point of time. And the third, from the government side, of course, the fiscal consolidation plan is in the target. Fiscal consolidation things are basically, what do you call, in the radar for the most of the government, which means they have to focus on the fiscal consolidation this year and the next year onward, and which means less support for the company on the ground, less financial as well as regulatory support for the company on the ground, which means most of the company who are literally into the edge of the bankruptcy have a highest risk of slipping into the bankruptcy. So from that, I will close my presentation. And one thing we need to basically mindful about monitoring those development, what's happening at a government level, what's happening at a macroeconomic level, what's happening in the geopolitical concern, which impacting the supply chain in turn, and all this scenario is likely to have impact on the balance sheet going forward. And balance sheet looks vulnerable at this point of time, for most of the countries. Thank you for listening, and I will pass to my colleague Tim, and he's going to talk about how we can help from that side. Thank you for listening. Over to you, Tim.
Thank you, Arun. Great insight there, and thank you for setting the table. I'm going to follow on from Arun's economic and macroeconomic view with a level down into the perspective from the companies that are operating in these quite pessimistic or gloomy economic conditions. And I'm going to talk through how we see companies needing to take an increasingly holistic approach to risk management, and not just focused on pure financial or fiscal or credit risk. Every quarter, DNB conducts a global business optimism insights report, and the Q2 report 2024 just came out. And while I would concur with Arun that there's a fairly negative or pessimistic or gloomy view at a macro level, there are some green shoots of optimism we're starting to see, and we're starting to hear from businesses across 32 different economies that we study in this report, that businesses are now feeling slightly more confident from an operating perspective about some of the conditions they're operating in from a global macroeconomic perspective. And the optimism index increased a few percentage points. It was from a relatively low base, but starting to see some positivity coming back into the economy. The overall financial confidence index on the right-hand side was essentially unchanged. And that gives us some level of optimism that companies feel as though they can continue to operate, can continue to manage their balance sheets and P&L, and can find ways to succeed in challenging economic times. On the other side of the coin, and Arun talked about this just a few moments ago, the largest concern or the largest drop came from a supply chain continuity perspective. I think some of the key component parts around shipping and transit of goods around the world, and rather than going through the Suez Canal, going around the Cape of Good Hope, it's a much longer route. It adds time to the supply chain, it adds cost to the supply chain, and that cost needs to be borne somewhere through that supply chain if it can't be passed on to consumers. And I think secondarily, on the bottom right of this, bottom left of this slide, it was kind of closely followed by the investment confidence that we assessed, which is largely attributable to the difficult balancing act between controlling inflation and controlling interest rates. And the general consensus seeing that the monetary policy loosening has somewhat delayed from initial views maybe 6, 9, 12 months ago, and higher interest rates continuing to stay as they are, and while inflation decreasing, maybe not having decreased by the rate that was expected 6 or 12 months ago. So yes, it is a volatile economic environment that companies are needing to operate in. From a short-term or short to medium-term perspective, there are some positive signs. So it's not all doom and gloom. This gives the next level down of the types of themes that we study in this insights report, and the shift between downgrading and upgrading. And not a huge amount of movement, as reinforced by the kind of overall index only changing a few percentage points. To try to pick out the positive view on this, the short-term economic outlook, 11 countries were upgraded from previous quarter. And that's the biggest shift for good or for bad that we saw. Maybe as businesses are starting to manage the new normal post-pandemic, starting to get used to the economic headwinds that are being faced, and finding ways to manage businesses effectively and even grow businesses effectively through those conditions. However, with the backdrop of increased bankruptcies and expectation of increased bankruptcies still for some time to come. What I'm going to go on to talk about is different trends and themes of risk that companies are now increasingly faced with managing. On the fiscal side, on the financial side, or the credit risk side, revenue protection is key in the current economic climate. Generally speaking, when the economic climate is tougher, recession times or increased bankruptcy times, companies tend to look within and manage, review, tighten, adjust credit policies to manage a greater level of risk externally, not necessarily opening up their doors to new customers in the same way as they would in more positive economic times, tightening credit lines, reviewing their portfolios, and trying to maintain a positive cash flow through that. However, with some challenges that get in the way of making that possible. An increased focus on automation, on integration, on replacing manual processes with automated or systematic processes, and making sure that data provides insight and doesn't just clog up the works, giving a view of what the path is out of a difficult economic position for each customer, for each business. And CFOs are telling us that they don't want to take additional risks in these times. They want to manage the risk from within. And there was a recent Deloitte survey conducted that hammered that point home loud and clear. And also the utilization of technology is such a critical component part to transform the finance function to enable a business to operate well in tough economic times. And some themes that come out through all of that. For businesses to remain competitive, business leaders must effectively manage risk and reduce cost, but also managing growth and managing top line, but in a profitable way. But increasingly, both regulatory, reputational, and brand risk needs to be managed so more tightly going forward, so that companies can continue to thrive and continue to survive and thrive with a growing regulatory environment and an expanding regulatory environment they need to operate within. And I'm going to go on to talk about that in a moment. The way we look at the kind of business landscape and how we help companies to ultimately grow profitably, we kind of break the world at Dun & Bradstreet into 3 streams. Who could I do business with? Who should I do business with? And who can I do business with? I'm going to talk today most around should and can. What is clear is that there is a lot of unknown, hidden, or misunderstood risk variables and attributes that need to be understood, connected together, and then make informed decisions for businesses going forward. And a lot of that is below the waterline. From a should doing business perspective, this is much more around financial risk, viability and health to continue to operate as a going concern, and understanding the moving parts around a business that you're either looking to buy from or to sell to or to partner with. In the finance function, the desire is to modernize, the desire is to automate, the desire is to digitize and streamline. And that's difficult for a lot of businesses where they find themselves, where they might have disconnected systems, they might have overly manual processes and tasks, got an increasing regulatory or reputational burden to manage, and the ability to get insight and actionable information from data is a struggle, particularly with disconnected systems, legacy technology, and manual labor-intensive tasks. And that has a knock-on impact in terms of managing working capital and cash flow. With the backdrop of a tough economic climate, it makes it doubly hard. Having said all that, there are some underlying principles that don't change. And our customers tell us this time and time again, and we hear this from the business community. There are some basic financial and credit risk management principles that remain the same. How much you're owed, the age of that debt, and then the risk of that debt. And companies that effectively manage their portfolio of risk connect this combination together. Not just understanding the worst payers or the biggest debt outstanding, but the combination of the three of risk, size, and age, and having effective strategies in place to manage and contain risk out of the existing book of business. To bring that to life, we conducted a study recently of all of the companies that are in our customers' credit risk portfolios. And that's thousands of companies doing business with thousands of companies. So you get millions and millions of data points. And the color chart shows the distribution of risk across the portfolios of all of our clients. And you would probably expect to see this kind of distribution, that you have smaller amounts in the outliers and a lot in the middle. But I think a really important point to call out here is that there is nearly, just over 20%, just over a fifth of the businesses sitting in the customer portfolios of our clients are in a moderate high or severe risk category. And typically, these wouldn't be companies that our customers would look to onboard. Their credit policies would tend to turn away from moderate, high, severe risk type businesses. But they are sitting within our customers' portfolios. And it really hammers home the point to me that in the credit risk space, so much focus is spent onboarding customers and making sure that all the information is understood and the right level of risk tolerance is understood onboarding a new customer, but much less focus on actually managing the risk out of the existing book. And it's almost recommendation to flip around the focus, that the risk exists on the existing book because that's where money is owed. There's potential future risk by onboarding customers that are of a too high a risk position, but making sure that there's a balanced approach to risk management across the portfolio is so key. And there are some never-ending, evergreen challenges within the credit to cash cycle that our customers and businesses also have to deal with. Growing fraud risk, and I'll talk about that in a moment. Traditional day sales outstanding and being paid according to terms or not. And then the desire to automate and free up time to make better decisions on the harder decisions to make. Those problems don't go away. In fact, some of these areas are growing significantly. On the fraud side, this is a view of 2023 and nearly 500 billion across the globe lost to scams and schemes related to fraud. Be that check fraud or advanced fee scams or payment fraud losses. And this is particularly seen because of the adoption of systematic, integrated digital engagements, where there's much less engagement between people, much more relied on online onboarding and money transfers and payments. And without the robustness of the processes that people historically would have enforced, and fraudsters are clever. They find ways around and they find dark spots. And fraud is growing as a problem globally, and particularly in the B2B and B2C space. If I switch slightly to the other side of the coin, whereas I was talking about kind of customer risk, think I'll now flip to the supply side. And as Arun talked about at the start, and I kind of reinforced, there's broader challenges, political, geopolitical challenges around shipping routes and around transportation of goods from point A to point B, but also generally a lower level of insight available for companies to actually understand the health and the position of their supply base. And this isn't just companies that are businesses buying from directly, but also upstream supplies, tier 2, tier 3 in the supply chain, and understanding the knock-on impact at the beginning of a supply chain all the way through to a business that's procuring goods and services as part of their manufacturing or production process. With an overall challenge being added to that around increased regulatory compliance and reputational burdens that need to be managed. Various studies over the last 2-3 years by some of the big four, by some of the research agencies, and by Dun & Bradstreet itself, there's some quite alarming figures here. Over 70% of CPOs reporting procurement-related risk has increased. 35% of organizations experiencing attacks on their software from a cyber perspective. And 2/3 of procurement and supply professionals stating ongoing monitoring of supplier risks as their greatest operational challenge. All with a backdrop of unable to be able to really make data, turning it into actionable insight, and to get insight and reporting that to manage supplier data effectively to combat some of these growing challenges. So it's not just a customer side risk, it's not just an accounts receivable challenge, it's an accounts payable and an upstream supply chain challenge also. Oh. And some of the factors Arun talked about. The cost of labor, the increased cost of shipping and transportation of goods and supply chain, increased regulatory burden, and a commitment, and I'll talk about ESG, environmental, social, and governance, and how that's growing and how that's both a force for good, but also a challenge that operationally companies need to combat. So that's on the kind of who should I do business with, from more of a financial risk assessment of either selling to or buying from. If I switch now for the final part of my presentation on who can I do business with, this is much more focused on rules and regs. So regulatory and reputational and brand risk, anti-money laundering, know your customer, anti-bribery and corruption, and some of the emerging regulations on the responsible sourcing or ESG side around corporate sustainability. Put simply, the regulatory footprint is expanding and will continue to do so, and the regulations that companies have to adhere to or want to adhere to from a reputational perspective is just getting bigger. As Warren Buffett said very nicely, it takes 20 years to build a reputation and 5 minutes to ruin it. Growing number of bribery cases. This is just picking out 2 or 3 examples from the UK. Some of these firms regulated, some of these firms not regulated because they're not in regulated industries, but bribery being a challenge that companies and their ongoing suppliers or customers need to combat and manage. Cyber. Cyber is not often talked about from our perspective, but is an increasing risk, particularly on the digitization of the commercial ecosystem. As fewer people are doing manual tasks that are being placed by systems and integration and digitization, cybersecurity risk is a real and genuine threat, and another risk aspect that the C-level and their operating teams need to be focused on. Just a few stats. 63% of data breaches are linked to third-party suppliers. 50% of organizations are not prepared to repel a ransomware attack, and 60% of organizations will use cybersecurity risk as a determinant in who they're going to do business with. So both understanding a business's position themselves, but also who they're engaging with and who they're integrating with and who they're sharing information with and opening up their doors to. And as I touched on, ESG related regulations, so environmental, social, and governance. A lot of the regulations are focused on the supply chain and making sure that there's appropriate practices in place for human rights and labor and operating conditions, and also from an environmental perspective, greenhouse gases and climate risk. And as you can see across this map, over the last kind of 20, 30 years, there's been various rules and regs that have been implemented, but particularly over the last sort of 2, 3, 4 years. And a lot of them particularly focused on the supply side. So this is both important from a reputational perspective, but also increasingly from a regulatory perspective to force businesses to have to comply with certain rules and regs, levels of emissions, human rights practices and labor laws, etc. To cut the story short, it's really just adding to the level of operational risk that an organization needs to consider and apply as they go about their daily business. And corporations have come under fire for not appropriately disclosing or acting on ESG issues. And again, not necessarily falling foul of regulation, initially reputational risk that then leads into the regulations of the future to try to combat this type of bad practice. So to summarize, without painting too negative a picture, I think, as Arun said, there is a very challenging external economic environment for businesses to operate within. There is also an increasing level of risk assessment that needs to be implemented and achieved. And companies that are succeeding, and we are seeing companies succeed, although there's an increase in the number of bankruptcies, there are still plenty of opportunities for growth. There's still plenty of companies that are succeeding based on either finding a way to increase demand or reacting well to an increase in demand for their goods and services. Companies that are succeeding are able to get a sight of what's below the waterline and able to connect together both traditional levels of financial and fiscal risk management to the ever-increasing regulatory burden and reputational burden, both on the supply side and also on the customer side and the third-party partner side, to be able to operate effectively so that below the waterline is understood to power how the company operates above the waterline. So while it is a challenging environment to operate within, there's still plenty of opportunity to be optimistic, and there's still plenty of opportunity out there for businesses to succeed by implementing and managing solid best practice in terms of how they're operating their companies, their supplier side, their customer base, understanding hidden risk, understanding opportunities for growth from either under-penetrated customers or new supplier opportunities. So while it is a gloomy picture, there is still some green shoots that we look to. Thank you very much for your attention. I'll pause now and I'll hand back to Madhu, who's going to facilitate a Q&A.
Thank you, Arun, and thank you, Tim, for taking us through the presentation. It was a very insightful session. We have a question in the chat box, and I'll jump right into it. But if you, for other participants, if you have any question or query, please feel free to type that in the chat box. We'll make sure that we have those answered. I think the first question that we have is about, I'll just read it, that if we go for a tighter credit sanctioning, does this not curtail business growth?
Sorry, could you ask that question again, Madhu?
So the question is, if we go for a tighter credit sanctioning, will it not be curtailing the business growth?
Okay, I'm with you. Yeah, so it is the age-old dilemma of how to balance between the two, is the level of risk acceptance, but also the credit or the finance function not being a preventer of business growth and business opportunity. I think, as always with these things, it is striking that balance. It's firstly understanding the risk of the existing book of business, and while there might be some areas of hidden risk that needs to be managed more proactively than a company might be doing already, there will undoubtedly be some areas of potential opportunity due to under-penetration, companies that aren't operating close to their credit limits, but have the capacity to do more business. So I think particularly when the external environment is tough, looking to see opportunities both to manage risk out, but also to manage revenue up within the existing base, I think is absolutely key. And then applying those policies to the onboarding level of risk for new customers, making sure that that the credit policy is well tuned so that there's not an unacceptable level of risk being taken on at the front end, which is just going to lead to a bad debt problem in the back end. but also making sure that the credit team isn't operating as a self-prevention team. So the question, I think, hits on a really important point, that there is a risk that being tighter on the credit policy can turn away good business. But by starting the assessment on the existing book of business and seeing opportunities to grow from existing customers, that's a great way to counter that challenge.
Thanks, Tim. That really sums up that question. We have a query that if we'll be able to share the presentation. Yes, the webinar is being recorded, and I'll be sharing a link to all the registrants and attendees shortly after the webinar. Uh, so if you have any question, please feel free to type that in the chat box. But I would extend heartfelt thanks to Tim and Arun for taking their time out and joining us for this lively discussion around global bankruptcy trends and businesses facing various types of risks. I think there we have one more question. I'll just read it through. A question for to understand better the context. What about the geopolitical risk, Israel, Iran, and Ukraine? Do you think that can hurt touristic models for the Southern Europe?
Yeah. So thanks for these questions, and that's certainly started impacting, and it's unfortunate that post-pandemic, this model or this business started seeing some light on the other side. But the geopolitical concern, we had Ukraine-Russia conflict, and then followed by the Israel, and then multiple other things happening. I think all have created another round of stress in terms of this model. This will certainly have impact, and the ground reality is showing some impact. And going forward, the change happening in terms of the geopolitical concern, change happening into the shift in some of the government in some of those countries, certainly going to have concern on that particular model. And just to put into the different context, 50% of the world's population, more than 50% of the world population, is voting this year. It's one of the very significant development happening. It's not just those conflict. It's also about the change of the governments also creating those change in the model. So just I think wait and watch. I think it's already some of those countries started feeling the heat. And going forward, unless this conflict subsided, we'll continue to have a problem for those of the countries who are highly dependent on this type of model.
Okay. Thanks, Arun. With that, I will wrap this session and extending my heartfelt thanks to the speakers today. Thank you, everyone, for joining, and we'll see you in the next webinar hosted by us. Thanks, Tim. Thanks, Arun.
Thanks, everyone.
Thank you. Thank you. Bye.